its outlook on Snapchat. The financial company reportedly marking up its shares in the messaging app during the month of October by 14%. This follows a markdown a few weeks back. Fidelity publishes monthly portfolio holding listings on a one-month lag as part of compliance with the SEC. But do these monthly filings cause more volatility in the startup market, and how exactly does Fidelity determine these valuations? Joining me now, Mark Seigel, Managing Director of Menlo Ventures, and back with us, Sarah Fryer of Bloomberg News, who covers Snapchat. And by the way, it's not just Snapchat that's being marked up and down here. It's happened to Dropbox, it's happened to Zenefits, and you know, when these were marked down a month ago,
it caused a shockwave.
Everybody panicked. Now they're being marked up slightly, but they're still lower than the value that Fidelity bought them.
Well, what Fidelity's done here is been one of the big fuel engines for these late-stage growth companies, giving them mutual fund money. What the companies didn't realize was that was going to mean that they would have to mark their shares to market. So they actually have a committee that reevaluates every month what these private companies are worth and decides. And it's not something that these CEOs expected. A lot of them, if you talk to them off record, they'll say, like, hey, we kind of feel like we went public without needing to go public.
Right.
So it's one of those things that venture capitalists are going to have to figure out, you know, what do they.
Let's talk to a venture capitalist right now, Mark Seigel. What do you think of all this? I mean, first of all, these are just on paper, right? But it does impact sentiment to a certain extent, doesn't it?
Well, it does. You know, I don't think we should overreact. I don't think these valuations mean a whole lot. Venture firms like Menlo Ventures update our valuations on all of our private companies every quarter. We're actually, we have to do that. And we use a variety of ways of doing that, and one of them is looking at public market comparables. And my guess is that what this valuation increase in this case by Fidelity reflects is that some of the comps that they're using for valuing these companies have gone up as well. But it really doesn't mean anything. It doesn't mean that there is no market for the company's stock, and so I wouldn't read really too much into either a markup or a markdown.
Right, but it is important to gauge the value of investments, right? And I wonder, with all of this talk about, are we in a bubble, are valuations too high, if it's sort of driving some of the downward momentum that we might be feeling.
Well, I think so, and I think the most important thing is it drives sentiment. I think that if, you know, by definition, kind of a downturn is when everybody thinks we're in a downturn and isn't as eager about buying stock at high prices. And so what we may see is certainly a lot more reticence on the part, particularly of these what I would call non-traditional investors in the private market, the likes of these mutual funds, hedge funds, maybe pulling back from making some of these large private investments that they've been making.
So, Sarah, does what Fidelity thinks matter?
It does matter, because a lot of venture capitalists have said that maybe they shouldn't have their startup take money from Fidelity. It's an extra risk. It's an extra judgment that they maybe don't have to go through if they wouldn't take that money. So there's some sentiment changing in the valley. This is one of the #1 things that people look at and say, oh, are some cracks in the system starting to show? Ooh,
right.
We'll have to see.
Mark, you know, these mutual funds and hedge funds, they've been called tourist investors in Silicon Valley. I mean, how do you advise your startup? Should they take money from the likes of Fidelity?
Well, you know, a big reason they've been taking the money is, of course, it's been made available, and they can get the money in a private transaction instead of going public and avoid the scrutiny of the public market. So I think that if they're going to be treated like public companies and be written up and down and have their financials scrutinized every month and have that information public, you can ask what's the difference between that and going public. I still think that there's an awful lot of things that are involved in being a public company in terms of regulations and things like that they're avoiding. So if you're a company that wants to stay public and wants to invest in growth and R&D and lose money, maybe something the public market won't tolerate as much, this is still a pretty good option. It happens to be the only option. But, you know, people might say, hey, maybe I'd rather take money from more of like a private equity firm as opposed to a mutual fund company if they're going to keep it quiet a little bit and not publicize it.
Now, the point is that even though the numbers are going up and down here, Fidelity is still in the red when it comes to its own assessment of its investments in Snapchat, Dropbox, Zenefits, and others. Mark, what are you seeing on your side? Are you seeing valuations? Are you seeing down rounds? Are you seeing delayed IPOs?
Well, absolutely. Companies are staying private much longer, and we are seeing some signs. I'd say we're seeing, very, very evident signs that this late-stage private market is kind of starting to crack. We see companies going out and they're not able to raise money at the valuations that they wanted to. In the case of Fidelity and other mutual funds investing and maybe being in the red, I think they're investing to have hopefully have a seat at the table when these companies do go public, and hoping to catch some really high flyers like another Facebook or Twitter or maybe an Uber and Airbnb fall into that category now. And I think they're willing to hold a basket of these companies, and even if they underperform a little bit, they feel like if there's one of these really, really amazing high flyers in there, they've probably still done okay.
So you're saying down rounds are already happening?
I don't think we're seeing down rounds, but I think we're seeing companies not go out and get the expected valuation that they want. But we haven't seen a whole lot of down financings, although, Square went out, obviously, and is valued today as a public company lower than where their last private round was.
Right. All right. Well, interesting, something that we're certainly going to continue to follow. Mark Seigel, Managing Director of Menlo Ventures, thanks so much, and Sarah Fryer, who covers Snapchat for us in addition to Facebook. Thank you, Sarah.